Welcome to ECP Conversations in 5 minutes or less, where our investment team shares insights on markets, industries, and the highest quality businesses we can find. I'm Damon Callahan, and with me is Manny Pohl, the Chairman and CIO of ECP, who shares his thoughts on business resilience and why it's a key feature of our investment strategy. Let's get started. Manny, you're well known in the investment industry for having built a strategy that focuses on finding exceptional businesses expanding their profitability over time. In this context, you talk a lot about business resilience, and I'm hoping that you can articulate what that means to you and why that's so important.
Well, Damo, in answer to your question, resilience is the ability of a business to absorb or manage change, disturbances or disruptions while still retaining structural integrity and also being able to maintain functionality of the business through the stress period. Over the years, I've found people that have guided in my thinking were not people that were in the financial markets, but people that were actually like electrical engineers or chemical engineers. And the electrical engineer guy that I always look at is a guy called Shannon. And the reason that he intrigues me is because when I was doing my BSc, my thesis was actually on sampling analog waves. We're talking 50 years ago now. So analog, which was the old radio that people used to hear, and then along came digital. And the quality of the signal or the sound that we heard, the music or whatever, was substantially better than analog. And you've got to say, well, how can that possibly be? Because you're only sampling something. And Shannon proved academically that was the case. I mean, we knew it by listening to the music. But he could prove it because what he said was that in an analog signal, you've got noise and you've got information. And the digital process extracts the information away from the noise. And he came out with this, the signal, what's it called, the signal to noise ratio. Why is that relevant to financial industries? Because we've got the stock market. The share prices reflect all of the information that's going on at that point in time. And people put a lot in store by the movements and they calculate mean variance, all this sort of stuff. But that movement has got noise in it and it's got information. And the ability to extract the information out is a key component. And that's what his whole theory was all about, is how do you extract the information from this analog signal, which share price movement is an analog signal. So he was very interested, and I'm very interested in what he had to say. And then the other one was a guy called Andrew Sterling, who was a chemical engineer and was looking at energy and the availability of energy. And what prompted me was Rumsfeld years ago coined that thing about the known knowns and the known unknown unknowns, but this guy came up with a variation of it, and it's a matrix which I think is fabulous. And he puts the axes into the knowledge about the outcomes and the knowledge about the likelihoods. So why is it relevant to us in and trying to answer your question about what is the type of business that we want to invest in? If you look at that matrix, you've got if you look at the knowledge of outcomes, you've got a continuum of outcomes and you've got a set of discrete outcomes, and then you've got outcomes that are poorly defined. The knowledge about likelihoods, you've got a firm basis for probability, you've got sort of a shaky basis for probability and no basis for probability. When you're talking about resilient businesses, they have to be able to deal with the extreme right-hand side of this matrix, which is poorly defined outcomes and no basis for probability. So you've got no information of what's happening, and you've got very little idea of actually what it's going to look like or where it's going to go, a black swan event. Sustainable businesses are those that have certain fundamentals in place which we look at, and it's the core of what we do. It's the strength of the balance sheet. It's the continuous ability to grow the revenue line and to produce some decent return for us as the investors. Now, the continued growth in the revenue line is the question that you've asked about reliability. And the key component of that is what we put in our approach to analyzing companies, which we call a dynamic capability. So it's within the business, the closed loops, to use engineering again, that exist where management are talking to the customer through whatever means, they're talking to their staff, and they're taking that information on board and they're reacting immediately to it and guiding their business through investing more in R&D to develop better products, or investing in their staff by training them. But it's that sustainable, that continuous reinvestment in the business and being in contact with everybody. That's, to me, that's the essence of a reliable business. And what it does is it takes out this extreme right-hand column, which the academics call ambiguity or ignorance, And the way they talk about compensating for that is precaution. For us, precaution is we don't even invest in those companies. We just avoid them like the plague because it's just too hard. So we say if these companies don't have these elements, then we won't have to deal with poorly defined outcomes. We won't have to deal with, in our approach day by day, that we don't have any basis or probability of where the share price is going or where the earnings are going to go. So I hope